Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. Today, we're going to be talking about the wealth pyramid. Now, in general, the wealth pyramid is something that I've created that basically gives us a stable approach to building wealth. This stems from my philosophy, basically, which is what gives us the highest likelihood of success. When I'm designing high cash value life insurance policies, what gives us the highest likelihood of success is minimizing the expenses inside of it so that we get more cash to grow and compound. Well, the wealth pyramid kind of takes that concept, and it applies it to basically everything that we can invest in. And so I think when we're looking at and listening to financial gurus out there and financial advisors, it's a good idea to know what's your philosophy. What direction are you coming from? We know Dave Ramsey likes to basically pitch no debt ever at all, and any extra cash after that, you can get 12% in a mutual fund. Okay, whether that's realistic or not is another story, but we know where he's coming from. The basis of what he talks about and the way that he wants to get people to succeed is to get out of debt first. That's good. That's a good philosophy. It rarely goes wrong, right? Like the only time I can see that going wrong is like he's convincing you to pay down or pay off more quickly a low interest mortgage, and you're just locking those dollars up in equity inside the mortgage. And then you hit financial catastrophe and you can't access those dollars without actually selling your house because you can't get approved for a mortgage. Nobody will approve you if you don't have your job anymore. You have no way to pay that loan back. So you end up having to sell your house. Okay, that's like worst case scenario. Probably doesn't hardly ever happen, but it is a possibility. There are other things that we look at doing other than necessarily paying off really low interest debt. But that's beside the point. The point is, what's the philosophy of the person or the people that you like to listen to? And you don't have to just pick one. You can kind of pick what you think might work best for whatever your situation is. But I want to show you mine, and this is where the wealth pyramid comes in. Let's take a look at it. So here's the wealth pyramid that I've created. The idea behind it is we want a solid foundation because that's the building block that will allow you to maximize your financial freedom and take advantage of future investment opportunities. Oftentimes, people will mistake high risk with high rewards, and they neglect the self-building blocks of a solid foundation in order to participate in riskier ventures. Like a lot of people want to get rich quick. Well, that can often lead to financial collapse. It doesn't mean it won't ever work, right? It has worked for some people. I often bring up cryptocurrency and Bitcoin. Sometimes it works, but for a lot of people it doesn't. And so what we want to look at again is what gives us the higher likelihood of success. So let's look at the base. The base that I've created here, it consists of stable sources of income and safety from catastrophic events. The things that are listed in here combine to provide stability and financial protection. Secure those before moving up the pyramid for maximum financial security. Let's start on the right there. We got shelter. Whether you own or lease, reliable shelter is critical to your financial stability. Without a safe place to live, you risk employment, asset loss, stress, fatigue, mental and physical health. We need to have a roof over our head. When we think about like what happens when people become homeless, one of the first things that goes is their mental health. And being able to maintain your physical health on top of that can be a challenge. So having shelter is like one of the key things there. And there's a number of different ways that we can achieve that. That doesn't mean you have to buy a house, right? It just means as part of our financial base, we want to make sure that we are secure with shelter. We have a place to live. We have a place that's safe, and it will allow us to focus on other things. Next, savings. We should have 3 to 6 months of savings that are easily accessible in case of emergencies. That includes a bit of cash for funds that might require an immediate need, like banks might be closed or power's out. Cash is otherwise inaccessible somewhere else. So we got some money in cash. We've got some money in a checking or savings account. This is for situations that might require access to funds within 24 to 48 hours. Now, we can also meet those needs with debt. or with credit cards, lines of credit, things like that, right? Borrowing from other people. We can do that. We can do it very quickly, 24 to 48 hours. The remaining emergency funds should be in a highly liquid interest-bearing account that you can access in 3 to 10 days. And we'll call that, we'll lump these accounts as high yield savings accounts, money market accounts, no penalty CDs, and cash value life insurance. So these are all things that we can access with a little bit of time, and it will allow us to meet emergency needs, because it's not very often that we need all of those 3 to 6 months emergency funds all at once. So we don't necessarily have to keep them on hand, right? As long as it's close by. We're not going to take our emergency fund and put it at risk in the market, because the market collapses. Suddenly that 6 months emergency fund turned into a 3-month emergency fund because the market dropped in half. Or your 3-month emergency fund turned into a 1.5-month emergency fund. Like, that's not good. We don't want that to happen. Next up, insurance. Lack of insurance in a tragic situation can set back a lifetime of prosperity. Ensure that you have the bare minimum of coverage, but strive for maximum coverage. There are limits to what you can insure. Don't just ask for the cost for the minimum coverage. Find out the cost for the maximum coverage as well. It might actually be a better value. Now, what type of insurance am I talking about? Homeowners insurance or renter's insurance? That type of coverage is critical. In the event of fire, theft, or injury, that type of thing, if you are not covered, can quickly devastate your financial future. And I would also consider looking into adding an umbrella policy that just covers everything above and beyond the actual dwelling and the structures and things like that. Auto insurance, it's basically mandatory everywhere, but check to see that your coverage is adequate for your needs. Often overlooked is uninsured motorist levels and overall liability levels. Best to get as much coverage as you can, in my opinion. That's what I do. Try and make sure we have plenty of coverage, because a car accident can happen at any time, and it could be devastating financially if your insurance does not cover all of what needs to be covered. If somebody were to get injured, there's too many stories about that. Not for us personally, but my wife used to work at a law firm for personal injury for 20 years. She makes sure that we have the maximum coverage that we can get. Okay, next, we've got health insurance. Health issues can derail the best laid plans. Medical bills are a leading cause of bankruptcy. Be sure you're prepared for unexpected injury and illness. So health insurance is often the best way to do that. There's all different kinds of plans out there. You could even self-insure potentially, but that's obviously the most risky. And, without health, what else do you have? And then, of course, we've got life insurance, whether it's insurance on you, your spouse, a business partner, an employee, or a loved one. Life insurance provides living benefits and death benefits. Properly designed policy can be used throughout your life to accelerate the growth of your wealth. There are ways that life insurance is used for pension maximization, personal banking, a flexible savings asset, supplement for retirement income, estate planning, and of course we get tax advantages with the growth. There's so many good things around it. It's why it's most of the focus of what I talk about on this channel. So we love that one. That one is definitely a part of the insurance portion there. Next, we've got pension or income annuities. Pension and income annuities are a guaranteed lifetime income stream that provide income for the rest of your life and possibly the life of your spouse. Employers provide pensions. They're slowly disappearing, with only about 7% of employers offering them now. But income annuities are products that are offered by insurance companies, and they perform the same way. So when it comes to, at some point, retirement, we've got to think about, what are we going to do to meet our basic needs? It's good to have a certain amount of permanent income, permanent stable income, so we can meet our minimum dignity floor. And that minimum dignity floor covers shelter, food, security, transportation, basically the things that you need to just live a basic life. It doesn't have to be anything frivolous, but we hopefully will eventually have savings or investments above and beyond that can help do the other stuff. Give us the ability to travel, make purchases that we may need or want when we get older. So pension and income annuities are ways to supplement the other thing that we're planning on using, which is Social Security. Social Security is lifetime income guaranteed by the federal government. It's constantly under attack. It's possible that it could be reduced. It's possible it could eventually go away. So I don't expect that to happen, But when we're thinking about our future in retirement, as of now, we're still planning on having Social Security, at least at some point. So we're going to use all of these things together to help build our financial base. Social Security will make up a part of that, unless something changes. We're going to want pension or income annuities to make up a part of that, as well as the other things we listed here in the base of this pyramid. All right, that's our safe things, right? That's everything that helps us and gives us the highest likelihood of success. If we've got that covered, it frees us up to do other things higher up the pyramid. So let's look at level 2, which is some conservative investment options. Now, you don't have to finish all of the base before you move up. If I'm 20 years old, I'm not thinking of an income annuity. You're probably not going to want to buy any type of annuity, something that you're not going to touch for another 40 years. There are other things that we can do to give us growth potential that give us access to funds, but will help to supplement us in retirement. So we don't need to be thinking about that. So just remember, we don't have to do everything that's listed in the bottom of the wealth pyramid before we move up. These are just the order of safety. As we go up the pyramid, it gets more aggressive and then extreme with the risk. So in the conservative, this is what I call the opportunity zone. Once you have your base covered, we should explore other opportunities to invest in conservative, cash flowing, and or tax advantaged assets. This level's assets should be tangible, relatively low risk options that perform well over the long term. View these assets as if your future retirement depends on it, because it probably does. So we've got the 401k and a 403b. These are employer based and controlled, but they are tax advantaged retirement accounts. Your money's going to grow tax deferred, and it's going to be taxed as income as it comes out, so upon withdrawal. IRA is an individual retirement arrangement. It's individual based and controlled. So this one is not controlled by your employer. The thing to know about the 401k and the 403b, this is good for building for the future, but to access it prior to retirement, so before 59 and a half, you might encounter penalties. You might have to pay taxes. And it's possible that you can't access it unless you quit your job. There are many employers that will not let you just transfer money out of your 401k if you still work there. That happened to us. We had a third child. We needed access to funds, and we had been funding my wife's 401k instead of saving. Instead of giving us some money outside of that account, we were doing what we thought we should do and contributing to our retirement account. Well, it turns out we needed that money before retirement because of an unexpected third child. So my wife ended up having to quit. Now, she worked at this place for so long and they rehired her back, but she had to quit so that we could get the money out of the retirement account, and then she was able to go back to work for them. So avoid that by recognizing where money is controlled by and planning for it ahead of time. The IRA gives you control. So it also grows tax deferred just like your 401k. It's taxed as earned income upon withdrawal, but has greater flexibility than the 401k and the 403b. One of the big differences between the two, though, is oftentimes you can borrow from your 401k or 403b. You can't do that in an IRA. So, slight difference. Next, we have the Roth IRA. These are individual based and controlled, but it uses after-tax funds and it grows tax-free. I love the Roth IRA. We can't put a whole lot into the Roth IRA and the IRA each year, but you can get a pretty substantial amount. And for people that are in the low tax bracket, a lot of our young folks, they should be trying to max that out when they're younger. $7,000 a year, which is where we're at right now on the max contribution, that can go a long way. If they can get $7,000 a year in there each year, they'll easily make it to a millionaire status before they retire, even if they don't do anything else. Next, we've got real estate. Real estate is a stable, fairly low risk investment. Depends on the type of real estate that you're investing in, how you manage it, but it's a tangible asset. It can get bought and sold. It doesn't tend to lose value unless some catastrophe happens. So it tends to be a fairly low risk investment. There are tax advantages through depreciation and 1031 exchange to defer capital gains. There are cash flow opportunities with real estate. So there's a lot of different ways to participate. Not all ways to participate in investing in real estate would be considered in this second level, the opportunity zone. There are definitely some ways that could be considered moderate to aggressive or extreme. Just be careful out there. If you are in the level 2 opportunity zone, make sure you're focused on stable real estate investment efforts. Next up, level 3. This is the fun zone. After your retirement goals are met, oh, I forgot. Here on level 2, I didn't list it up there, but I would also include ETFs and mutual funds that are market-based. So like the S&P 500, NASDAQ, Dow Jones, something where we're investing in many, many companies, that would also be considered in level 2, and I would consider that conservative. Now, most of the time, we're going to be doing that inside of these 401ks and 403bs and Roths and the IRA, but not always. You could do some after-tax brokerage options where you're adding money into an after-tax brokerage account. There are some good tax opportunities long-term into the future that we can take advantage of, even with an after-tax brokerage account. So there's a good argument there to put that in that level 2 zone. Okay, on to level 3. This is your moderate to aggressive. Now, after your retirement goals are met, you can branch out with your wealth building opportunities. These assets should still be tangible. Now, when I say tangible, that means like we're talking about a physical asset. But with these ones, we're free to go for some short-term gains, explore alternative investment options, and any other opportunities that arise. This includes stocks. Your investment in stocks, like these are individual companies. So your investment is going to be at the mercy of those companies. Individual companies can go bankrupt, and that can end up being worth nothing. That's why this is in the moderate to aggressive and not in the conservative, whereas investing in a broad-based ETF fund would be conservative, because if you've got 500 of the largest companies, they're not all going bankrupt at the same time. In fact, you might only get 1 or 2 that might end up going bankrupt at any given time. And what happens? They get moved out of that fund, and a new company moves in. So those are definitely a lot safer. If we're just doing stocks in individual companies, this could be, maybe you're doing day trading, or maybe you just want to invest in particular companies that you like. You'll want to be able to ride out the downturns, and you don't want to tie up funds that you'll be forced to withdraw at inopportune times. So we got to be careful how much money we're putting into level 3 investments, to where if the stock market crashes, we don't have to sell everything at the low. We want to be able to ride that out. And that's kind of the same philosophy with all these things. So royalties can be a good way to generate long-term cash flow, but there's no guarantee they're going to pan out, and they might not be very consistent. It can be fun to own a piece of a popular song or movie or play, though. So I know there's a lot of people that get into that stuff. Then we've got life settlements. These are guaranteed to pay out eventually. The risk is in tying up your funds for unknown lengths of time, but the returns can be worth the wait. Now, a life settlement, that is an investment company that purchases life insurance products that people no longer want. So it eventually pays out because everybody dies eventually, right? But we don't know when that payout's going to be. But there are some options out there that you might be interested in taking advantage of. And then finally, we've got other tangible investments. That means you're investing in something of substance that can't just disappear or lose all value in an instant, like starting a business, investing in art or other commodities, things like that. So anything that doesn't just lose value instantly. Now, let's go to level 4. Level 4, this is the extreme risk. And the way that I like to look at it is like, if you've covered your bases, you prepared for retirement, and you successfully explored the fun zone, there's probably not a reason for you to even get into level 4. Extreme risk does not equal high reward. It most often just leads to losses. So maybe consider donating to a charity instead. The stuff that you would put up there are things that are not tangible, right? Something that it could definitely go to zero. So like we're talking the crypto coins out there that Joe Blow just created in an instant. He's trying to get you to buy in because it's going to be the next hot thing. And you can get 1 million of them for $1, right? Those are likely to go to zero. It could be something that you have fun in. It doesn't take very much money. That there could potentially be a high reward, but you definitely don't want to risk a lot, right? You're not going to be throwing large dollar amounts into something like that. So just consider, if it's not tangible, it could go to zero. It could completely go away. You could lose everything. Doesn't mean you won't necessarily want to do it, but be judicious in it. When we're looking at the wealth pyramid, we want to make sure that we're building that base, and it gives us the opportunity to play around up near the top without risk of it toppling over. Now, what a lot of people do is the opposite. they'll start building on risky investments, and then what happens? It can tip over. If those fail, it can tip over because you didn't build your base. And sometimes there's no recovering from that. So if we build properly, we'll be able to recover from catastrophe, and eventually we will build the wealth that we're looking to do. So that's my stable approach to building wealth. I hope you find this helpful and informative. If you have any questions about it, leave a question in the comment section below. I'm definitely willing to have a discussion, especially if you think that I might have missed something, or you're wondering, hey, I'm thinking of investing in this. Where does that fall in the wealth pyramid? So I look forward to the discussions. If you want to have a one-on-one meeting with me to discuss this or anything else that we talk about on this channel, link is in the description below. I look forward to seeing you soon. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.